Hey guys, this is Market Update. In this video, we're going to look at the next leg of growth for Bitcoin in this cycle. I think there is one leg left, big upside move, and it's going to center around one event, which is the refinancing of the US debt by the Fed dropping rates, helping the Treasury refinance a little bit. We don't know how that's going to come around. There's going to be a lot of volatility around it, but that's the next leg, and I believe it does happen. You can see we're trading around 67,000 here. It's amazing. We're literally consolidating under all-time highs, despite some recent FUD, weakness in markets right now, maybe a little bit of profit taking from a lot of the narratives that have gone off this year. But we're consolidating under all-time highs at 67,000. It's pretty positive, right? But when you look at the long-term trend, it shows a different story, which is we're actually just around the trend rate of Bitcoin's growth, this orange line. So we're not overbought. Now, a real bull market is when you come up to this, blue line right here, which depending on the time horizon would be anywhere from 150 to 200,000. So not price predictions, but I think areas where you would expect the price to go if we get that next leg. I believe that happens because government debt has to be refinanced. It's unpayable, right? They're running deficits. I'm talking about the Fed here as well, because they're really the linchpin here, right? When they start helping the Treasury refinance the debts again, then you get that next leg. So I think that happens. I think Bitcoin prices it in. And so that's what I'm here for. All of this short term, this 20-30% moves and stuff, totally irrelevant because that next leg is what I'm focusing on, that really big move up to the top band. Now, when we get there, then you have to worry about, is inflation going to start really inflecting to the upside again because, they've printed money and maybe the stimulus is coming in. All of that, we can worry about that at the time because that's potentially the next bear market. But for right now, we have the bull market ahead, which is this asset pricing in currency debasement. If you do trade, check out Bybit down in the description. Click the link there, make a deposit. You can get up to $30,000 as a deposit bonus if you trade. Just check the link for the details below. All of the economic metrics we see on a daily basis fed to us through the mainstream media, which are the metrics the government wants us to focus on, like GDP and CPI and PCE, core PCE X. Some of these other metrics are inflating highly, so we don't want to include them. All of this is designed to distract us from the real issue here that no one wants to confront, which is at the government level, there is no money and there are obligations that they can't pay through the tax receipts. And so they have to create more debt to pay those obligations. So you're creating debt to pay off debt. Now, for a household, that's really bad. For a government, actually, you can just carry on doing that forever, right? Because there's no knock on the door saying you're bankrupt. The knock on the door is essentially other nation states who get very upset, and eventually that just leads to war, right? So let's hope we don't go there. But this is the fiat system, and it just carries on like this. The way they try and reduce the amount of debt that the government has to pay on a nominal basis, what you look at, what they have to pay, is money printing, which is taking some of the wealth that we've created for ourselves and just taking it away and paying off the debt to try and keep it down a bit. That's what global liquidity cycle is. So where central banks print money out of thin air to buy the government debt and the government securities. So when that happens, you debase the currency, and so all other assets have to price that in, right? Because you're not creating wealth when you print money. So they have to price that in. You got more money, you got more currency units, we price that in. When global liquidity trends higher, so does Bitcoin. You can see this one here. This is global liquidity, very positive, Bitcoin bull market here. And as it draws down, Bitcoin bear markets. Potentially, we are going into another breakout here, as you can see. So that would be the next leg. I think this will happen because this is what central banks do. They're actually designed to debase the currency. That's why they exist. But if we look at the economy itself, right, the real economy, we don't think we're doing very well right now, right? No one's really saying, wow, the economy is doing great right now. Wealth creation is really high right now. Everyone's kind of thinking things aren't right. But if you look at the official GDP numbers, they're really strong. So what's happening here? Existing home sales is negative. We've been negative for a very long time. That happened back in 07, 08, happened in the pandemic. Obviously, it just shows, a fairly weak structure for the economy. Home builder inventory is spiking as well. Again, doesn't really seem like a very strong economy or a growing economy. Durable goods, non-defense is negative, which is very rare. It shows, maybe some weakness in the economy, right? But then you look at GDP and it's like 2.8%. Wow, the GDP is 2.8%. We've got strong growth. We're doing really well. 2.8% GDP. Why aren't you doing well? Because the economy is growing. Look, this is an economic expansion, expanding economy because GDP is high. You can see we're actually really strong in terms of GDP. they call it an economic expansion. But when you realize that the only reason GDP is high is because the US national debt has now increased by $3.5 trillion in 13 months, days away from hitting 35 trillion, you realize that GDP is positive because of this fiscal stimulus. And so why is GDP apparently so strong, 2.8%, and they're creating this much debt? If GDP was really strong, if the economy was creating wealth, why do you have to create this much debt? So the GDP figure being positive doesn't mean anything. It doesn't mean anyone's creating wealth. It means that the government is creating so much debt and pouring it into the economy that it is pushing GDP higher. But that doesn't mean that we're creating wealth. That's the issue. To go a bit further on this as well, and I'll link this post below because it is eye-opening, this is the amount of wealth held in the States versus government obligations. So I'm focusing on the States because it is really the main area to focus on. It's where most of the wealth is, where most of the wealth flows through. It's really the important one, but many other countries are in this state as well. 177 trillion is the total assets there. That includes American households, non-profits, hedge funds, PE funds, personal trusts. 177 trillion. As we come down, you can see liabilities. So one line here is social insurance, social security and Medicare, 78.4 trillion. However, that is understated, and in total, the total sums to 175.3 trillion. This need can be satisfied only through increased borrowing, higher taxes, reduced program spending, or some combination. Not great, right? So what you're looking at is a potential de-wealth event, right? In terms of the amount that has to be paid out coming from the wealth that is currently there. Now, wealth can be created as well, right? You can create wealth to try and pay this off, but that only comes through taxes, right? Because the government can only pay this off through two ways, taxes or printing money. The entire FedGov only collected 1.86 trillion last year. That number itself is reduced by a deficit spending. The dollar is down 25% in real terms since 2020. And the 177 trillion in asset value plummets if liquidated, or if there's a financial crisis, or both, right? And so essentially you've got these obligations. So how do you pay for the obligations? Well, you can tax people, and you need inflation because the amount of tax that you take from people needs to keep going higher. So as long as asset prices and everything's inflating, you're getting more taxes. However, asset prices going up isn't great because, of course, as we've seen, the tax is just not enough to pay this anything back off, right? It's not enough because we're still having deficits right now. The other way is to print money. Now that also creates asset price inflation, because what you have when you print money is money isn't wealth. When you print money, you're not creating wealth. So what you're doing is actually stealing some of the actual wealth that's created by the people that hold that currency as savings. And the way that they become poorer is not by you taking their money away. It's by them seeing all the stuff that they want to buy go up in price. And that's being poor, right? If the things you want to buy go up, but your currency buys less of that, that is becoming poor. So it's a de-wealth event, right? If you want to pay this off. Now, how do we fix that? There is no fix. It's just going to carry on in the same way, which is they're going to print some money to try and make sure that they, pay the obligations that they need. They're going to create these cycles where they, print some more money because the dollar is going to get wrecked as they pay off these obligations. So how do you protect from that? Well, you can't be in the currency. You can't be in the currency. The obligations are too high. The only thing that has to get wrecked is the currency. Could they come and take some of your assets away? Obviously that's very bad if that's going to happen. You can see that in Europe, there's a plan to actually have a national EU register of privately held assets, including cars, houses, equities, and everything else. I don't know if that's going to go through or get denied in EU Parliament or whatever, but you can see that debts are starting to really pile up and governments are worried about it. And how do you need to confiscate people's wealth. Taking stuff from them, going to their house and knocking on their door and saying, we're just going to take some of your stuff. They can't do that, right? And so the way that they do it is through bamboozling us and saying GDP is higher, don't worry about it, and just taking a bit out of our currency strength every single year. This isn't going to stop, but don't worry, we have tools to help us. Bitcoin is the purest tool in my opinion, but of course other equity indices if you want to invest in those. But Bitcoin is the solve for this to get out of that system to protect your savings, because your savings in the fiat currency are going to get wrecked. So investing, right? That's why we're seeing so much financialization right now, because people understand that something's wrong. They don't quite get it, but they need to get away from that. They want to get close to the money printer. They need to make money, right? And so I think the best option is Bitcoin, because it's strong and it's a fixed supply currency. We know all of the benefits. That is why BTC and other investments as well. If you're investing in a house, that's a currency derivative because it's a debt-based instrument at this point, right? You need to get a mortgage to get that. And it's going to price in currency debasement. But if you're in a very mature economy without much growth, you're not actually going to make money from the house. Why would you make money from the house? If you're in assets that have actual fundamental growth and adoption, like Bitcoin, crypto, tech, those things are going to protect from monetary debasement, fiscal stimulus, pushing asset prices higher, and also, potentially get some investment returns on top, which is really the sweet spot where we want to be, and why this channel is about crypto and Bitcoin. If you do trade crypto, check out the $30,000 deposit bonus to Bybit in the description. Also, the Crypto Investor course, the price will be going up at the end of this month because I did update it. However, if you are in the course, all of those updates are free for you as always. So if you haven't watched the videos yet, check them out. Just some more analysis on this current cycle. I'm James, it's Manager G. Cheers for watching, and I'll see you in the next one.